We're going to be talking about adjusting journal entries, and we're going to be looking specifically at deferrals. We're going to look at deferred revenue, which is more commonly called unearned revenue, and deferred expense, which is more commonly called prepaid expenses. There are a variety of deferred expenses: office supplies, prepaid insurance, prepaid rent. Believe it or not, depreciation is a deferred expense. We're not going to talk specifically about depreciation because there are separate videos which address that, and we'll let you look at those videos. So we're going to only talk about deferrals, and the other type of adjusting entry are called accruals, accrued revenue and accrued expense. That'll also be in a separate video. We have to adjust a variety of accounts to make sure that revenues and expenses are recorded in the proper time period. Okay, so let's take a look at 3 examples of deferrals. We'll have supplies, prepaid insurance, and these are both deferred expenses or prepaid expenses, and unearned revenue, which is deferred revenue. Now, the reason we call them deferred is that in the case of supplies and prepaid insurance, which, by the way, these are assets that go on the balance sheet, the money for the purchase of supplies and the purchase of the insurance policy takes place first. We pay the money first, and we defer recording the expense until a future time period. That's why they call it deferred expense, because the expense will be recorded in a following time period. Let's look at supplies. On January 1st, we purchased $3,000 of supplies. And at the end of the month, let's assume that we have, on January 31st, we have $600 of supplies on hand. On hand means they're still in the cabinet. So I went to the supplies cabinet, and rather than day by day recording the cost of a Post-it and a staple and a pencil, that's ridiculous. I simply, at the end of the month, I'm going to go to the supplies cabinet and I say, okay, we have about $600 of supplies in the cabinet. We call it, say we have it on hand. That means it's kind of in inventory, if you will. So that means we use $2,400 of supplies. So my adjusting journal entry is to debit the supplies expense account for $2,400 and to credit supplies, and that's how I show that I have $600 of supplies on hand on January 31st. All adjusting journal entries have at least one, or have one balance sheet or one income statement account on them, and you'll never see the cash account debited or credited in an adjusting journal entry. Try to remember those rules right there. Now, what I want to do is a couple of things. First, I want to show you the impact on the income statement if you don't record an adjusting entry. So notice we have 2 columns. We have with the adjusting entry, and that's the correct column. And here's if we forget or we don't even know what an adjusting journal entry is, and this is what the income statement would look like without the journal entry, and that's wrong. Okay, so we're going to isolate each individual adjustment to show the impact. So my supplies expense was $2,400. I always like to put brackets around my expenses. So really, my net income is not $18,000, it's $15,600. If I did not record the adjusting entry, I'd think net income was $18,000, but it's not. It's really $15,600 because I only have $600 of supplies on hand. Now, I want you to try to follow along thought process-wise. If I did not record this adjusting journal entry, okay, then I would think I have $3,000 of supplies, which is an asset. I don't, I have $600. So my assets, here's my assets, and on the right side is liabilities and equity, right? My accounting equation. My assets would be overvalued. If I did not record this adjusting entry, I'd think supplies expense was either 0 or a lesser number, when it really needs to include that $2,400. My supplies expense, my expenses would be undervalued right here. If expenses are undervalued, net income is overvalued. If I think my expenses are $32,000, then I think net income is $18,000. My total expenses are $34,400. Net income is $15,600. So, on the left side of the accounting equation, assets are overvalued if I don't record the adjusting entry. And since income would be overvalued, that flows into retained earnings, which is stockholders' equity. Assets overvalued, stockholders' equity overvalued. I'm still in balance, but I have mistakes on both the income statement and now on the balance sheet. And that's why we have to record adjusting journal entries. It's very important. GAAP requires us to do this. If you don't record adjusting journal entries, you're violating GAAP. It's the same thing with prepaid insurance. Prepaid insurance is an asset. It's going to become an expense. It's a deferred expense. We'll assume this is a 1-year insurance policy, and so that means $48,800 divided by 12 is what, $400 per month. And by the way, some companies will adjust on a monthly basis. Some will do so on a quarterly basis. Some may only do it on an annual basis. It's up to the company. In this example, let's assume this will be a quarterly adjustment at the end of the first quarter, March 31st. So $400 for 3 months is what, $1,200. Okay, so I'm going to record my adjusting journal entry of insurance expense, $1,200, and I'm going to credit prepaid insurance, $1,200. Okay, so I'm going to credit prepaid insurance, $1,200. That'll leave a balance of $3,600, and I'm going to debit insurance expense. So now let's go over here, and we'll start this process again. Let's look at the impact on both financial statements. This is my adjusting journal entry, and like I said before, notice this is an expense on the income statement, and prepaid insurance is an asset on the balance sheet. You have one balance sheet account, one income statement account on all adjusting journal entries. Previously, supplies expense income statement, supplies assets on the balance sheet. All adjusting entries have a balance sheet account and an income statement account, and they never involve cash. If I did not adjust prepaid insurance, because remember, what happens when an insurance policy expires? You renew it and you pay again. So at the end of 3 months, I've used 3 months of insurance. If I did not record this adjusting journal entry, I'd think that I still had $4,800 of prepaid insurance as an asset. I don't. I have $3,600 worth. So my assets would be overvalued if I didn't record the adjusting entry. And my insurance expense would be lower than it should be. It should include $1,200. My expenses would be undervalued over here. If I think expenses are $32,000, I think my net income is $18,000. My expenses are really $33,200, and net income is $16,800. So if expenses are undervalued, income is overvalued. Remember, this is what we have to do here. And income flows into retained earnings, which is stockholders' equity. So the accounting equation, if I don't adjust, assets overvalued, equity overvalued. We have a mistake on the income statement and on the balance sheet. Same effect as supplies because they're both deferred expenses. It's the same thing with equipment when you depreciate. Okay, the last adjusting entry for deferrals will be deferred revenue. Now let's assume we're a landlord and we own property and we rent it out and we received 3 months rent in advance on January 1st. Okay, we charged $2,000 a month and they paid us for 3 months in advance. So on January 1st, I debited cash and I credited unearned revenue. I have not yet earned it. It is unearned. Remember, this is a liability. This is not revenue. Now, at the end of January, we're going to do a monthly adjustment. I will have earned 1 month's rent. So what I'm going to do is I'm going to reduce the liability by 1 month's rent. And that shows that I still owe $4,000 of either money, or in this case, I have to provide service, which is providing our facility. And now I'm going to recognize revenue by crediting, not service revenue, but rent revenue in this case. Let me cross that out. rent revenue. Okay? And so the adjusting entry, I'm going to debit unearned revenue, and I have to abbreviate, 2,000, and I'm going to credit rent revenue for $2,000. That's the adjusting entry. Unearned revenue, liability balance sheet. Rent revenue goes on the income statement. Okay, now let's do our income statement adjustments here once again. In this case, we're dealing with revenue. So I'm going to put rent revenue up here, $2,000. And so that means my net income is really $20,000, not $18,000. If I did not record this adjusting journal entry, I would think that my liabilities were $6,000. They're not. They're $4,000. So now here's my accounting equation. I'm going to step back, which means I'm on the right side of the equation. These are liabilities. This is equity. Liabilities would be overvalued. I would not have recorded rent revenue if I did not record this adjusting entry. Revenue, which flows into equity, would be understated. So liabilities overvalued, equity undervalued. We're still in balance with assets. We simply have mistakes on both the income statement and the balance sheet. Over here in the income statement, if I don't record this adjusting entry, I think my total revenues are $50,000. Expenses are unaffected by this adjusting entry. I think net income is $18,000. But my revenue is really $52,000, and therefore my net income is $20,000. So if I don't adjust, now I'm underreporting income, which flows into retained earnings, which is equity, and equity is undervalued. So what makes adjusting journal entries tricky is you have to really think through what is the effect on the financial statements if I don't adjust the various accounts. Okay? So these are 3 examples of deferrals: deferred revenue and deferred expense.